Hello and welcome to another accounting video. In this video, we are going to look at HKS 8, which is on accounting policies, changes in accounting estimates. It also includes changes in accounting policies, and errors. Again, I would like to bring your attention to this part here. This is a summarized version only for quick revision. So you must study your relevant notes, learning packs that you have in your preparation. So let's get started with this standard called HKS 8. So in this video, we are going to look at these items. We are going to see the scope of the standard. What is accounting policies and examples? What is a change in accounting policy and what is a change in accounting estimate? How do you treat each of these individual two different things? That is, how do you treat a change in accounting policy and a change in accounting estimate? Finally, we will look into accounting errors. So let's look at the scope of this standard. The scope of this standard tells us that the company will apply HKAS 8 when selecting and applying accounting policies. What are accounting policies? Accounting policies will be defined in the next slide, but an example could be the company's depreciation policy. This is an example of what accounting policy is. So there are two types, right? SLM, which is a straight line method, and then double declining balance method, commonly known as DDB. Right, and then it also includes, the scope of the standard also includes any changes in accounting policies, plus any changes in accounting estimates, and any errors that have been made. This is referring to accounting errors. And we will look into detail what each of these items mean. So what is an accounting policy? Accounting policy is a specific principle, basis, conventions, rules, and practices applied by an entity in preparing and presenting financial statements, right? So financial statements, there are different types of financial statements, 4 types of financial statements. There is income statement, there is balance sheet, there's a statement of changes in equity, and then there's cash flow statements, right? So there are rules, there are accounting rules and policies that companies must follow in order to prepare these financial statements, and that's what is called accounting policy. So I have given 2 examples in here for general depreciation policy. So for example, straight line method or double declining method, it's an example of accounting policy. This is an example of accounting policy. Similarly, at what basis the company measures their assets. So you can either measure your asset, the company can either measure the asset at cost or revaluation basis, right? So this is about basis. There are different accounting principles. For accounting principles, we can talk about revenue recognition. Another principle could be prudence concept. So these are all accounting principles. So this is a brief introduction to what accounting policy is and what are different accounting principles. Let's look into what is a change in accounting policy and what is a change in accounting estimate. A change in accounting policy is a change in the basis of measurement. So I have given an example here. So company changing from double declining method to a straight line method. So this is a change. This is a change in depreciation policy. Similarly, there's another thing called change in accounting estimate. A change in accounting estimate is when there's a change in the carrying amount of an asset or liability. So you have to focus here. This is the keyword. Which differentiates between accounting policy and accounting estimate. That is, this is an adjustment to the carrying amount. So for example, change in the life of fixed asset, that is a change in accounting estimate, because a change in the life of fixed asset changes the carrying value of your asset, of the company's asset on the balance sheet. So similarly here, they say that the results from the assessment of present status and expected future benefits and obligations associated with the assets and liabilities. So these are the changes that take place. So it changes the company's value of asset and liabilities. So any change which implements on the carrying amount, which affects the carrying amount, is called change in accounting estimate. So let's look at the treatment of an change in accounting policy and the change in accounting estimate. If there's a change in accounting policy, the standard says that the company should apply retrospective application. In other words, in layman terms, the company has to go back in time and make appropriate adjustments. Sometimes it is impracticable to do so, for which I would say you should refer to conditions. These conditions are mentioned in standards, the accounting standard HKAS 8, and I will link down the complete standard in the description below, so you can easily find the PDF version. It will list all these conditions when it is impracticable to apply the retrospective application when there is a change in accounting policy. This is really important. These are huge conditions. So in this brief video, it may not be possible to discuss those here. Then there's a change in accounting estimate, which basically is based on prospective application. In other words, the company does not go back in time to change any numbers in their previous financial statements. The company just start from the present and carry on further. Let's look into accounting errors, which is the last part of this video. Accounting errors can be of any type. There could be recognition error, there could be measurement errors, there could be presentation errors, there could be errors in presentation, or there could be errors in the disclosure of elements of financial statements. So for example, you did less disclosure. Example of measurement could be, if you remember, the inventory should be measured at lower of cost or NRV. So for example, if NRV is less than the cost of inventory and the company measured the asset at cost, that would be accounted as an error. In the company's books. Similarly, there could be recognition errors as well. So for example, instead of recognizing the item as an asset, you record it as a liability. So there could be different types of errors which would affect the financial statements, and these errors will affect the compliance with the HKFRS. So in other words, it will not present a true and fair view of company's financial statements, right? So how do you correct? So this is basically correction of errors. You restate your comparative amounts. The company will restate the comparative amounts for the prior periods presented in which the error occurred. So if let's say the error occurred in 2013 and you're preparing financial statements for 2014, you discovered the error in 2014, so you have to go back and correct your error for your 2013 financial statements. If the error occurred before the earliest prior period presented, then the company has to restate the opening balances of assets, liabilities, and equity, depending upon how the error is affecting these nature of assets, liabilities, and equity. There are also disclosures. There are different types of disclosures for changes in accounting policy and changes in accounting estimate and errors. Different disclosures are required for each of these three types, for which I would recommend you to refer to the accounting standard HKS 8, and I will give the link to the standard in the description below for your easy reference. I hope this video was helpful to you. If you think this video was helpful to you, please give it a like. You can comment down below on which standards or which accounting standards you find it difficult, and I may try to make a video on that. If you would like to subscribe to my channel, that would be great as a motivation. So please feel free to subscribe to my channel. Thank you very much for staying till the end and watching this video. Thank you very much.